Hello, everyone, and welcome to the year-end review for John and Jane's combined portfolios. This includes all of the taxable and retirement portfolios that I normally produce over 3 videos. And I wanted to release this before those because I think this has some interesting insights and provides a really interesting big picture understanding of what their retirement looks like across all the portfolios. This is going to be a lot shorter video, and so let's jump into some numbers. I'm not a financial advisor and I don't claim to be one, and this does not reflect the views or opinions of my employer. I have a lot of positions similar to John Jane. I state those in the individual videos, but there's too many here for me to bother with listing. And then this is a real portfolio, real shares are being traded. Normally there are some screenshots from Charles Schwab. Those are included in the regular videos, but in this case, it does not work well for showing all of their portfolios combined. So there are no screenshots, just the normal tables that I would include in the other videos. John Jane's background: John retired in 2018 and collects Social Security. Jane retired in 2021, collects Social Security, and they are currently withdrawing $2,700 a month from all of their accounts, in addition to the Social Security income that they receive. And then John and Jane have no debt or monthly payments other than basic recurring bills. So basically, they make their finances about as simple as can possibly be, and that makes my life a heck of a lot easier. So for the big headlines, John and Jane's portfolios generated over $82,000 of dividend interest income for 2023, and that compares with $76,500 of dividend interest income in 2022. And the portfolios currently have a combined balance of 1.78 million, and that compares with 1.7 million or the same time period in 2022. So that's an increase year over year roughly of about $85,000. And then as far as the full year comparison goes, so income has increased 7.2% year over year. We can see that the average income year over year has increased by about $460 a month in terms of what they can draw. And then when we look at the total income increase, it was just over $5,500. But I added this little table here to kind of just, I like to think about things a little bit differently sometimes, or at least get a different perspective. But it's the amount of income generated that month relative to the balance that the portfolios combined ended with at the end of that month. What I found interesting here is that you'll notice that income as a percentage of assets for January and for May were the same, but the income in January was, over $500 more than what it was in May. And part of the reason for this was that the balance in January in the account across all the portfolios was substantially higher than what it was in May. So when you're looking at the income as a percentage of assets, this is going to fluctuate considerably based on what the balance is in the account. And so, like I said, nothing earth-shattering, but just I think another interesting way of thinking about income. And then as far as their account goes, so the $2,700 a month that they currently draw, they could withdraw another $4,000 to get up to $6,700 a month and still be cash flow positive. So cash flow positive is basically the number one goal that we have with John and Jane's retirement, because that's what prevents us from having to sell shares unnecessarily, or at least putting it off as long as possible, in particular when you're talking about the traditional IRAs and the mandatory withdrawals that are needed from those accounts. And then for the portfolio balance comparison, 2023 December balances are the highest levels recorded for the year. So we had a pretty volatile year, in my opinion, in 2023. We ended about where we started, at least in terms of from January to December. But the in 2022, the average balance was slightly higher than what it was in 2023, even though we ended at a higher point here. And when we look at standard deviation, which is going to be part of the bell curve analysis, one standard deviation being 71,000 dollars for 2022 and then 55,000 for 2023. And what that tells us is that the 2023 groupings, even though it is volatile, they were tighter in terms of the difference between the highs and the lows and the outliers. Whereas in 2022, the difference between the highs and the lows were greater. So for example, here you can see that in September, this low was much lower than any of the lows seen in 2023. But also you can see here in March that the highs were much higher than they were in 2023. And that's the reason why we're seeing that there's a greater degree of standard deviation for 2022. I do have a typo here. John and Jane received a total of $32,400 of income, but they also saw their account balances increase in value year over year by about $84,500. And so if we add in my typo here, their income or their account balances, had they not collected anything, would have been up about $117,000 year over year. So, I just think it's, again, another interesting activity to say, okay, what if they didn't withdraw anything? Where would we be? Would we be positive? Would we be negative? Well, we'd be substantially more positive, even though we're already quite positive when we look at that $84,500 a year increase year over year. And then as far as the 6-year income comparison goes, the average annual increase here by month, I included this. Shouldn't probably surprise anyone because these are the months that tend to produce the most income. But we have March, we have June, September, and then December. Those were the months that had the highest increases in income. One of the things that's going to impact this now is how much CDs are being used, as compared to a heavily equity-based portfolio before, where increases can happen. With CDs, those same kind of increases aren't happening, right? But nonetheless, we do know that March, June, September, and December are going to be the times of the year where the biggest increases are seen, because those are also the times of the year where where the biggest amount of income comes from. But what we did here was we excluded 2018 from the cost of average goods returned average here. And the reason why is because it bumps this number up to like 14%. And I think that's completely unrealistic to make it seem like that's 14% year over year growth over a 6-year period, because in 2018 is when this was first getting established. So we know that income did not nearly double, from January 2018 to 2019, because when we look at this, we can see that there were some times where it did take some pretty good jumps, but doubling is not something that we would expect it to do. So I didn't want to set the false expectation by adding in January. So this 10.39% is from 2019 through 2023. 10.39%, so let's call it 10.4%, is absolutely phenomenal, especially with the highs and the lows. That is a return that any retiree should be plenty happy with on their dividend growth income based portfolio. And then the other thing I think that was interesting, and again, take it with a grain of salt, because 2018 was a year where everything was, getting established, is that we've seen income grow from, 41,000 in 2018 to over 82,000 in 2023. So over a 6-year time frame, the portfolio now produces double the income that it was in 2018. Now, I don't expect that next year, it'll be double, what it was in 2019. And that's what I mean by take it with a grain of salt. But I still think that it's really cool to see how much income has grown over time. And even though there hasn't been a deposit into the portfolio since 2020. We have still seen substantially, the income increase year over year, and that's a really, again, just neat thing to see. And then for the cash balance comparison, so average cash balances show that we definitely had more cash on hand, coming in at 107,000 here, which beats out all the averages of the prior years. But this does not include CDs or Charles Schwab money market, which represents where a huge amount of cash is currently sitting now. So when we look at the 6.29%, it's just saying that relative to the average balance in the account, the average amount of cash that we had represented 6.29%, and that is truly of just cash as far as the investments go. But as of currently, we have a total of $150,000 invested into CDs, and we have another $95,000 in Charles Schwab money market. And so including cash, there's a total of $324,300 of cash, money market, and CD funds available. So using this in our average annual balance, we have just shy of 19% of all holdings in these type of liquid and low risk investments. And so that's something that is definitely different than what you've seen in prior years, where everything was primarily based in equities. And the reason for that was because that was when equities were the only thing that were paying reasonable dividend yields. And so that was the only way to be able to generate income. Now that we have some alternatives, some safer alternatives, with all the volatility that we've had, it makes sense to shift them over. And speaking of volatility, this table is going to give you a really good perspective on just how volatile their portfolio has been, and why I cannot emphasize enough that the goal for investors is to generate income, because income being generated is something that as long as it's being generated, then you have income. But if you have a portfolio where you are dependent on selling shares or anything of that sort, especially if it's something to meet like your required minimum distribution, you are taking a lot of risk in hoping that you can sell shares at the right time of the market. Looking back to 2020, someone who needed income in March would have been just completely demolished if they had to sell shares. They'd be selling at massive discounts. And that's something that people also do when they get scared, is that they sell, hoping to preserve the cash that they have. But if you would have waited until the end of the year, then things would have been significantly better. What's a little bit different about 2020 though and 2023 is that I consider 2023 to be the most volatile year, and the reason why is because we started out at just under $250,000 of unrealized capital gains. By the time May rolled around, that number had dropped to just over 60,000. And then when July rolled around, it was back up to $192,000. And then by the time October rolled around, it was at a loss of 5,000. And then by the time September rolled around, it was back up to an unrealized gain of 146,000. So what you can see here is that the capital gains, the unrealized gains, I should say, there's a lot of volatility here, whereas when you compare it to 2020 just went really deep into the negative. It wasn't like it bounced really high into the positive, which would have then indicated it, but also it tended to be that it went really low, and then it kind of recovered a little bit, bounced back up, and then it really recovered, and then getting into the end of the year. So anyway, I would say that all this volatility is part of what support the idea of shifting to safer investments, because this level of volatility is just it's mind-boggling when you think about it. To actually have something go from being $250,000 in the positive to $5,000 in the negative. And we saw a lot of that same volatility, though, when you look at it in 2022. The lows were pretty low and the highs were pretty high, and that goes back to the standard deviation piece. So as far as the withdrawals comparison, so they were able to withdraw an additional $8,400 in 2023 as compared to 2022. I have had some comments before where people ask, why John and Jane don't withdraw more. I don't have any rules on what they withdraw. I just ask that it be less than what the cash flow is. And most of the time, it's actually me having to push them to withdraw money from the account. So, yeah, I just want to point that out, that when it comes to the withdrawals, it's most of the time me pushing them to take the additional funds. And so it's just their conservative nature in the fiscal sense. And I think it's great that they don't want to do that, but there's a lot more money that they could be withdrawing, and even with this $8,400 month pay raise, there's still plenty of money that they could withdraw if they needed to. And then I also like to look at, okay, well, what if that $32,400 was reinvested in a 5% CD? Something where John and Jen go, hey, we don't even need the money. This is the power of compounding, in the sense that, they could generate an additional $135 a month of income, just from putting that money into a CD and collecting it, if they wanted to. But with the increases across their portfolio in terms of the raises that have been given, and the increased amount of income generated, I expect that this next year will be pushing them up to closer to about $3,000 at the minimum, unless they want more. I'm definitely going to encourage them to increase it to $3,000. And then as far as the conclusion goes, market ended the year on a strong rally. If you've watched my previous videos, though, I'm pretty skeptical. I think there's some trends that we're seeing, and it just really has me concerned about the direction that things are going to go in the economy. And then, John and Jane's income potentials increased consistently for the last 5 years at an average of 10.4% across all their portfolios. And so even with the good and the bad years, a 10.4% increase in income every year is more than what my income gets increased by, in terms of like my annual raises and things like that. So that's more like what I would have to, I'd have to get promotions in order to get that kind of income increase. So in terms of them being in retirement, not having to do anything for it, I think that there's a lot to be said about a 10.4% annual increase in income. I do want to point out that next year I expect that income growth is going to likely be slow, and that's for a couple reasons. So the biggest one I would say is going to be that fixed income investments don't typically have interest rates that increase over time, and the ones that are due are tied to the yields set by the Federal Reserve. So in this case, with the Federal Reserve expecting to potentially lower the rates next year, then things like the Schwab money market, I expect that rate to be dropped. But also that any CDs that expire that have to end up being renewed, those CDs would have to then be at lower rates more than likely. So if the Fed drops rates really quickly, then it's possible that we could even see no or even potentially negative income growth next year. Just depends on how fast and what rates drop to. So that's just a big caveat going into 2024. But with how much income their account is generating, and with the fact that we're focused on average increases over time, this does not necessarily have me concerned. It's just something that I expect to potentially see happen. If the Fed really holds off until the end on those rate drops, then it's possible that they'll see, I would say probably in like the 4 to 5% range as far as an increase next year. And then the tables that you looked at show portfolio that's moving in a more conservative direction. And then even though the goal is to place less focus on capital gains and losses, does not mean that you should ignore them altogether. So there's a huge difference between accepting that risk exists and reducing risk when it makes sense. And this is why we continually trim back the high cost shares when it makes sense to, so that we have funds to be able to use when the market falls, and then it's a buying opportunity. So, when it comes to the portfolio moving more towards fixed income investments, it does not mean that we are going to avoid or ignore capital gains or losses altogether. It just means that this is not the primary focus in terms of making sure that John and Jane have a sustainable retirement. Because if fixed income was paying enough that we didn't need some of these other investments, and we could get things that were paying that yield for a long enough term, it's possible that I'd look at eliminating a lot of their portfolio to do that. The reality is that the rates aren't paying quite enough for me to justify, why we would do something like that. So, and then also there's if it's the taxable account, there's a lot of consequences of potentially selling off a bunch of things that are at high capital gains. And even if you're investing it in something that has a great yield, the taxable consequence could be so high that it could really defeat the whole purpose of what you're doing. So anyway, I would love to see some comments. Thanks everyone who's been watching the videos. Let me know if there's anything I can be doing better, and hopefully, it's been a little bit disheartening to see how much things have slowed. Not really, I don't understand the YouTube algorithm, but nor do I make these videos to, try and necessarily, go viral or do anything like that. I just want to try and help as many people as possible, and give people perspective on this. So, but yeah, if you can add any comments or anything like that, would greatly appreciate it. A thumbs up. Anything that helps the YouTube algorithm would be greatly appreciated. Thanks everyone, and have a happy new year.